Hey, good morning, options traders, and a big welcome to all of the new traders we've had here recently. And a topic that's come up a lot in the past few weeks is about volatility. Different topics, different ways to measure it, and also some of the traps that traders fall into. So let's talk about that. Specifically, how accurate is volatility? Because when you're looking at your broker's platform, you see a number, and it leads new traders to think that it is, for some reason, super accurate. And then they use this number to base all of their calculations for whether they should sell naked puts or whether they should do this strategy or that strategy. So it's a good question. Let's take a look at how accurate is this volatility number that you're looking at. Well, remember when we talk about volatility, there are really two basic volatilities that we're concerned with. There's historic volatility and there's implied volatility. Now, yes, I know there are others. People say there's a forecast volatility and a realized volatility, and those are more just specific moments in time, or maybe just another term for our prediction of it. But when you get right down to it, there's really two that we're concerned with. What has happened in the past, because that's our best prediction of what's going to happen in the future. And then there's the implied volatility. What does the crowd or what does the market think will be the volatility over the life of the option? And that's really what we're trying to reconcile. Is the crowd's guess reasonably in line with what's happened in the past? So again, what we're trying to figure out is, well, how accurate are these numbers? Well, the first thing is that the historic volatility is an actual number. It's just a straight up calculation. I've shown it in previous videos. Really easy to do in an Excel spreadsheet. But the point is that if you look at broker A, who says here's the volatility of Intel over the last 30 days, it's going to be exactly the same number as broker B over that same time period. It's just a calculation. So that is very accurate. And unfortunately, again, people think that this means that it's somehow set in stone, that this is a really accurate number of what we can expect. Now, it turns out that most of your broker platforms will use a 30-day historic volatility as a guide for the future volatility. That is typically what's used. And there are pros for using this, and there are certainly cons. But let's talk more about the negatives. So what we're trying to find out in this video is how accurate is the historic volatility, even though it's a specific number. So let's say that we go back and we look at 30 days worth of closing prices and we come up with a standard deviation. It is just a standard deviation of a sample. So don't let the terminology scare you. What statisticians call a standard deviation, traders call volatility. It's just looking at how spread apart are the data relative to the average. But you have to remember that it is a sample. It's one of many things that could have occurred. Yes, we can look back and say, well, here's what actually did occur, but that doesn't mean that that's all that could have occurred. We have a stock that has a certain characteristic. You could almost say a certain personality, and it can give lots of different distributions, even though the underlying mechanics might be exactly the same. So for a simpler example, think about coin flips. If you flip a coin 100 times, you're going to get an average number of heads at 50. I think that's pretty self-evident. If you did this lots and lots of times, the average would be 50. However, the standard deviation is 5. And most of the time, we're going to look at 2 standard deviations to get a much more accurate confidence interval. So that's 10. So under the bell curve, 2 standard deviations is 95% of the area. And that means that you could get somewhere between 40 and 60 heads 95% of the time. So to make this clear, let's say that you flip a coin 100 times, but you repeat that experiment thousands of times, each time flipping it 100 times and recording the number of heads. What you're going to find is that 95% of those trials, you're going to get somewhere between 40 and 60. And yes, that means that 5% of the time you're going to get either something less than 40 or something greater than 60. So don't think that those are the only numbers that have to occur. You could get 65 or 70. They're just going to be rare. But most of the time you're going to get somewhere between 40 and 60. But think about it. That's a pretty big range. If the average is 50, you're 20% off on either side, and that's a very big difference. So what does this have to do with historic volatility? Well, here's a graph of 30% volatility, and if we go back and look at, let's say, 10 days worth of data, we get a very big standard deviation, 0.09. If we come up here to 30, we get 0.05. But if we come way out here, let's say to 200 days worth of data, see, we can shrink this estimate way down. And the more data that we collect, the more accurate we can make this prediction for volatility. But there's a problem. Think about it. If we go back 200 days, that might be including time periods that aren't really relevant today. So for instance, right now, we're in late 2021. So we're a little over a year and a half outside of coronavirus. Do we want to go back so far in time, trying to get this estimate really, really close, but now including a time period when volatility was 85%? I doubt it. That's probably something we don't want to include. Do we want to go back to the crash of 87, probably 35 years ago, when volatility was over 200 and something percent, just so we can try to get this number really small? Probably not. Not a good idea. So see, it's a little bit of a catch-22. If you go back too far in time, you're going to start running the risk of including time periods that just aren't relevant. But then if we stick with fairly short ones, like 30 days, on the good side, yes, we are including data that's probably more relevant for the next 30 days. But here's the problem. So again, let's ask the question, how accurate is this historic volatility? Well, if we use the traditional method of 30 days of closing prices, and let's say we come up with a volatility of 30%. The standard deviation that we get, or the volatility number that we calculate, remember, is for a sample. And statistically, what we have to do is we have to take the volatility, 30%, divided by the square root of our number of days of 30. And that's the 5.5 number that we saw on the previous chart. So if we want two standard deviations, we have to take 2 times 5.5, or roughly 11. But now here's the kicker. How big is 11 compared to a volatility of 30? It's about a third. So think about that. Yes, if you're using a 30% volatility, but it was calculated over the past 30 days, you could be plus or minus 33%. And this is one of the most important points to understand, especially for the newer traders who may be taught to, just look back at your historic volatility and then make your calculations. It's not quite that easy, and this is why. And this is also why I've talked about in recent videos about stress testing your positions and looking at lots of different possibilities. Because the historic volatility, even though it is a specific number, is not really all that accurate. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.